Joining me now on Bloomberg TV and radio is David Bahnsen, founder and managing partner of the Bahnsen Group. David, thank you for being here. Obviously, we've seen some incredible bouts of volatility over the last week or more. Do you see talk of exemptions or flexibility as putting that volatility to bed for now?
No, I don't, because I think it exacerbates volatility longer term when there's more unpredictability. Now, what we mean by controlling volatility is that we get some up days in the market. Then I think it will do that because obviously markets want to believe that there's more and more carve-outs, exemptions, waivers. In other words, that there's less taxation, that there's less impediment to trade. But that doesn't neuter the volatility in the sense that there's an unpredictability driving a lot of the up and down movements in equity, fixed income, and currency markets.
Well, if we can focus on the equity market, I do want to get your take on fixed income as well. I wonder how much volatility is going to be exacerbated by the fact that we're now in the midst of earnings season as well. David, realistically, the backward look at the quarter they're reporting is one thing. The forward look, trying to provide guidance, is another. Do you realistically think any company is going to be able to do that? And what are we likely to hear?
Some are more able to do it than others, but you're certainly right that there is a general sense in which forward guidance is going to be very skewed and in some cases not offered at all. We've already had some companies announce that they can't offer forward guidance. You know, there are some companies that are less import-export driven than others, but either way, I think forward guidance is right now going to be very cloudy, and that also adds to volatility, which I think is your point. So there's a lot of issues that make it difficult to get a read on forward earnings, and we always have to remember that's what stock markets are, is a discounting into the present of forward earnings. When that gets cloudy, the whole picture for stock prices gets cloudy.
So within that kind of cloudy, murky picture, David, is there an area within equities that you still feel safe being right now?
Well, most areas of equities I feel safe being because I view equities as an asset class I want to own for the long term. So cloudiness, murkiness, short-term volatility, up, down announcements from administration, those all have to be baked into one's asset allocation. We're dividend growth investors at my firm. We have a complete confidence in the sustainability of growing dividends from the companies we own. And so that gives us an underlying confidence. Now, that's different than saying that I don't expect there to be price volatility. I think there will be, particularly with more economically sensitive and cyclical stocks. Financials and energy, we know of the issues in technology, communications, but then you see some of the issues like in defensive sectors. Today, the bond proxies, real estate, utilities did very well. I think healthcare is much less sensitive to this and consumer staples as well.
Well, you talk about the bond proxies. Let's talk about treasuries themselves, which you alluded to earlier. After a 50 basis point move to the upside on the 10-year last week, we come back down another 12 basis points today. What exactly do you see happening here, David? Do you subscribe to the theory that there's some government out there that's actually dumping these assets?
No, and in fact, I think it's rather obvious that there's not. And so the way this is played out required a few different stages of understanding. There was a deleveraging that Secretary Bahnsen referred to. That was clear as could be for any of us who are inside the market, that at the peak 4-day sell-off after April 2nd, there was delevering. You saw it even in some of the safer sectors of the market, of the equity market. But then I do believe that the basis trade and some of the hedge funds unwinding a lot of the leverage they've extended to people in the futures market, the hedge funds being on the cash market side, added to some disruption. But it would be totally counter China's intentions and objectives to strengthen their currency in this moment, which is what selling U.S. Treasuries would do. We have $36 trillion in national debt. China owns $1 trillion of it soaking wet. Japan's right around the same. Canada's a tiny drop of that. So I don't believe it's foreign unwinding. And we have to remember, when you say 50 basis points, we hit 390 for about 5 minutes a week and a half ago. We had been at 440 the week before that. So we really just sort of round tripped on bond yields. It's volatile, but no, I don't see any signs at all of foreign unwinding.
All right, David Bahnsen, founder and managing partner of the Bahnsen Group. Thank you so much for joining us.